Need funding for your real estate investment deal? Longhorn Investments is professional, reliable, and fast. Currently serving Texas, Tennessee, North Carolina, Missouri, Alabama, and Indiana, Longhorn Investments, LLC is a direct private lender offering short-term acquisition and renovation capital to real estate investors for both residential and commercial assets. With Longhorn Investments, you can receive up to 75% of ARV, finance up to 100% of cost, close in 3 to 5 business days, no income requirements, a streamlined, simple approval process, and no prepayment penalty. Formed in 2008, Longhorn Investments has funded over 4,000 loans since its inception and includes complementary businesses, including a title company and real estate law practice. Longhorn's wealth of experience puts them in the unique position of being able to help investors throughout all aspects of each transaction. To get started today and see why Longhorn Investments is the superior lending experience, call and speak to Lawrence Hopkins at 314-749-7616. That's 314-749-7616. Or visit Longhorn Investments at longhorninvestments.com. Longhorn Investments. Hard money lending simplified.
Universe. Media. Network.
Good day. I'm Samantha Smith with your United States real estate investing news. Along with the option to work from home and pad ever-growing savings accounts, some U.S. citizens are buying up properties above market value, which is pricing out lower-income demographics who have experienced the worst of the pandemic. Quoting Connor Doherty and Glenn Thrush of The New York Times, like the broader economy, the housing market is split on divergent tracks, according to the annual State of the Nation's Housing Report released on Wednesday by Harvard's Joint Center for Housing Studies. While one group of households is rushing to buy homes with savings built during the pandemic, another is being locked out of ownership as prices march upward, and those who bore the brunt of pandemic job losses remain saddled with debt and in danger of losing their homes. Millions of households were financially unscathed coming out of the pandemic, said Alexander Herman, senior research analyst at the Joint Center for Housing Studies. But the pandemic has left millions of others struggling to make their housing payments, especially lower-income households and people of color. End quote. Even with dispersed federal stimulus payments, many people have still struggled once those amounts have gone out to pay for overdue rent amounts, leaving any other necessities to be funded from meager savings. Again, quoting the New York Times, while a big new wave of evictions seems unlikely, the end of the federal freeze has injected uncertainty into tenants' lives and tilted the balance of power back in the favor of landlords. Tenants' rights groups have begun pushing the Biden administration for a 1 to 2 month extension of the freeze to account for widespread delays in the processing and distribution of federal emergency housing aid. The administration is weighing an extension but has signaled it would be contingent on public health considerations, not the housing market. We've avoided some of the worst outcomes so far, but the crisis is not over, said Diane Yentl, president of the National Low-Income Housing Coalition, an advocacy group that has pushed for increased housing assistance. If the Biden administration allows the federal eviction moratorium to expire before states and localities can distribute aid to households in need, millions of households would be at immediate risk of housing instability and, in worst case, homelessness. End quote. With the U.S. rental vacancy rate at a noticeable low and rents on the slow incline, it's becoming more difficult for renters to find a place to lay their head and take a breath. Quoting the New York Times, as the economy opens up, renters at the high end of the market are greeting a world of 10% vacancy rates and frenzied competition that has buildings offering as much as 5 months of free rent. Tenants in search of a moderate or lower-priced unit will find a vacancy rate that is half as high and essentially unchanged from a year ago. With competition fierce, rents in lower-end units grew at a faster rate in the first 3 months of this year than they did in the year before the pandemic. Judge Sergio L. de Leon, a housing court judge in Fort Worth, has seen a steady rise in evictions since the start of the year. As leases that were locked in during the pandemic begin to expire, he said, landlords are now increasing rents. It's sad, he said. End quote. With the fearful rise of real estate prices, for many people in the low to moderate income demographics, the delicious, baked-in, apple pie American dream of homeownership may be expeditiously becoming a barren desert mirage. As a real estate investor, you may be in the prime position of immense generational wealth creation. Quoting Carl W. Smith of Bloomberg, the numbers paint a stark picture. After peaking at 69% in 2004, the homeownership rate fell every year until 2016, when it was 64.3%, its lowest level since the Census Bureau started keeping track in 1984. The rate rebounded in Donald Trump's presidency, hitting 66% in 2020, but that trend is likely to be arrested by a housing market that is desperately short on supply and seeing month-over-month price increases greater than they were in the frenzied market of 2006. This process is painful, but it's not all bad. Slowly but surely, most Americans' single biggest asset, their home, is becoming more liquid. Call it the liquefaction of the U.S. housing market. Liquid assets, like publicly traded stocks and corporate bonds, earn what's known as a liquidity premium. Their market price is many times the dividend or coupon that investors get from holding them. The more liquid an asset, the higher that premium goes. On the flip side, those same high-flying stocks and bonds can see their prices collapse when investors get spooked and withdraw their cash from the market. Houses have typically traded with very little liquidity premium. That meant a relatively low purchase price compared to what it would cost to rent, the equivalent of the dividend from housing investment, and stable prices over time. These two factors made houses a good investment for moderate-income families who often lack the cash and the risk tolerance for market investments. As investments went, single-family homes were cheap and slowly grew in value in both good times and bad, end quote. Although seemingly safe and stable, the U.S. housing market may have been the elephant in the neighborhood the entire time. Again quoting Bloomberg, it may have seemed at the time like a failed experiment. But financialization had changed the housing market forever. Houses are now more prone to be priced high relative to rents, and to see their prices fluctuate with the market. The very features that made home buying an affordable and stable investment are coming to an end. But the illiquidity that made houses a safe investment also made America less dynamic and mobile. In coastal markets with strong demand for housing, market forces would normally have led to the replacement of single-family homes with duplexes and apartments. But existing homeowners are reluctant to agree to development with unknowable effects on the value of their most precious investments. The result is less development, and sky-high rents for any residents not lucky enough to own their own home. A nation of renters could lead to a world where location decisions are driven far more by personal preferences and life cycle demands. Younger workers might prefer the excitement of the city. A couple just starting a family could reunite with their parents or siblings in a small town. The U.S. is not quite there yet, and not just because too many people are chasing too few apartments. To see the U.S. as a nation of renters requires a revision of the American dream of homeownership. This country was always more about new frontiers than comfortable settlements, anyway. End quote. With millions already raised, two of the world's biggest tech magnates have plans to create a landlord out of anyone by only investing a small amount of capital. Quoting Patrick Clark of Bloomberg, Jeff Bezos and Mark Benioff are backing a startup that lets regular people invest small amounts of money in single-family rental properties, as the pandemic-fueled housing market continues to attract a flood of capital. Arrived Homes, which offers shares in rental properties for as little as $100, raised $37 million in equity and debt from a group of investors that includes Bezos Expeditions, the personal investment company of the Amazon.com Inc. founder, and Benioff's Time Ventures. The round was led by Core Innovation Capital, according to a statement on Wednesday. The startup, founded in 2019, has acquired 15 homes and is in contract for 18 more. It plans to use the new funds to buy more properties as it tries to democratize a corner of real estate investing that has been the domain of affluent individuals and, more recently, Wall Street firms. There are millions of people who want to own property and don't have a way to do it, Chief Executive Officer Ryan Fraser said in an interview. The reason they don't invest is that there are huge barriers, end quote. Even though mom-and-pop real estate investors still control the lion's share of U.S. rental homes, large firms are hot on their heels to snatch up as many as they can unearth. Again, quoting Bloomberg, historically, single-family rentals were dominated by local investors, who might own a handful of properties in their hometown. That changed following the U.S. foreclosure crisis, when Wall Street firms snapped up distressed homes at auction and developed systems for managing properties across sprawling geographies. Still, rental houses were largely ignored by big investors until COVID-19 set Americans racing for larger suburban living spaces. Brookfield Asset Management Inc., Nuveen Real Estate and others have committed billions to purchasing rental homes since the beginning of last year. People have always been interested in real estate investing, but it's gone from spectator sport to more of an active game given the ability to do more and more online, said Rick Sharga, Executive Vice President at Realty Track, which provides property data for investors. You put up the money and someone else buys the real estate and manages it for you and sends you a check every month. While the recent influx of institutional capital has attracted attention, mom-and-pop investors still own the vast majority of rental houses. Arrived Homes isn't the first company to allow small bets on single-family rentals. Roofstock, an online marketplace for rental houses, offers fractional ownership to affluent investors. Fundrise, another online real estate investment platform, recently lined up a $300 million credit facility from Goldman Sachs Group Inc. to buy newly built single-family rental houses. Fundrise has acquired or is under contract for roughly 2,000 homes, often outbidding institutional investors. It wants to buy more than 25,000 properties in coming years, according to CEO Ben Miller. We've been able to lower our operating costs below those of traditional real estate companies, Miller said in an email. We believe this gives a competitive advantage, allowing us to win more deals while simultaneously providing better overall returns to our investors. End quote. For our quick content suggestions this week, we have tips for flipping multiple properties at once from Think Realty and Forewarned and Forearmed, how to invest ahead of a housing bust from MSN. To research further, see links and more from these reports in the news notes. I'm Samantha Smith for United States Real Estate Investor News, UnitedStatesRealEstateInvestor.com.
Let's face it, your property is ugly as ARS Construction does it right. From roofing to exterior to all your interior needs. For a free roofing estimate, call now at 844-445-ROOF. That's 844-445-7663. Or visit AdvancedRoofSYS.com. That's AdvancedRoofSYS.com. ARS Construction, roofing and construction done right.